What's going on, everybody? Welcome to part 6 of the Quantopian tutorials. In the previous tutorial, we covered how to build our pipeline data, and basically that's going to be the pipeline that we're going to use in our trading strategy, which, the pipeline is basically the crux of at least a simple strategy where you can hopefully calculate everything you need to, or at least as much as possible within the pipeline, and then you can make trades based on that. So in our case, we've computed all the things that we need, actually, because we've got longs and shorts. And every day we would just ask, okay, what are the companies in our longs? What are in our shorts? Make sure our portfolio consists of that. Done. Now, what we can do, though, is with this pipeline, we can return the data, which will just be the sentiment data, and use Alphalens to analyze the alpha factor, which is sentiment factor, or at least what we hope to be an alpha factor. So up to this point, I really haven't talked too much about alpha and beta. At the simplest level, alpha is a measure of your returns that is basically irrespective of the market gains. So you want alpha to be high because basically we have to compare trading strategies to what about just buying and holding the S&P 500 index fund. So buying and holding the S&P 500 index fund has almost no risk. Obviously it's got market risk, but it's got not much risk. So anytime you decide to do trading, you're introducing risk. Also, buying and holding the S&P 500 index fund is also going to give you dividends, for example, which trading, you're not going to get those. So when we make the decision to trade, it's really important that we're doing it for the right reasons. So sometimes it might be to actually hedge the market. So maybe your objective isn't actually to beat the market, it's just to hedge it or decrease volatility or something like that. There's a lot of reasons people actually get into the market. So anyway, alpha is something we want to be very high. We'd like it to be as high as possible. And then beta is basically, a measure of your returns that are basically attributed to the market. So you'd like beta to be neutral. You don't want it negative because you're basically doing the opposite of the market. And you don't want it highly positive because then it's like your returns are just basically a multiple to some degree of the market returns already. So we don't want that. We want neutral beta, as close to 0 as possible. Quantopian likes to see anything between negative 0.3 and positive 0.3. Alpha, you just want it to be positive as possible. So anyway, Alphalens is going to analyze the alphaness of something. Before we get too far, I'll just bring up, I'm not sure these are the actual latest Alphalens docs, but you can also check out, I just actually pulled up something here, but oops, I didn't want to go that far back. I just want to go to Alphalens. You can also come to the GitHub and kind of look through. Alphalens, at least at the moment, isn't actually too complex, so I'm not really certain that a lot of documentation is even required at this stage. But you can kind of poke through, and that's kind of what I was doing. I was looking at the tear sheet, which I'll talk about momentarily. So yeah, let's go ahead and jump into working with Alphalens just so we can see the output. So first of all, when you run a backtest, what's going to happen is you're going to take your pipeline data, which contains a bunch of tickers, and then basically if you want to make a trade, all the backtester really has to do is be like, okay, you'd like to make a buy. What's the price? Checks the price. Cool. We'll save that until you want to make a sell. You make a sell and it's like, what's the price right now? And it sells. Whereas with Alphalens, the objective is to compare your sentiment factor, or your factor, it doesn't have to be a sentiment factor, your factor over time, over the entire trading period, compare your factor to the market returns of all the assets you might be interested in. And it's just going to generate alpha there. So what you want to do is you want to abstract away as much as possible and pull away your strategy. You don't really want to check alpha for your strategy so much as you do for this signal, because if either the signal has alpha or it doesn't, but just because you run a backtest and you make money, that doesn't really mean that the signal you were trading on actually had any alpha. You might have just got lucky. So it takes a few backtests to find out. Also, if you run a backtest and you didn't make money, that also doesn't mean your signal didn't have alpha. It just meant your strategy was bad. So instead, what you can do is you can just test the alpha. So that's what we do with Alphalens. So first, what we need to do is, like I said, in the backtest, it just checks prices. when you make the trade. But what we want to do is check prices throughout the entire period, basically, of this signal, which is basically from the year of 2015. So what we're going to do first is we need to know what assets we need prices on, because we don't want to track prices on all 8,000 companies. So we're going to say assets equals result.index.levels 1.unique. So what the hell does that mean? So result is our pandas data frame. Index is the index, which happens to be, it's a dual index, right? The index, this index is the date, this index is the ticker. So we want the firstth, this index, and we want to know all the unique tickers for that entire data frame. And then let's go ahead and just len assets, just so we can see. So we're dealing with 522 companies that we want to get pricing on. So now we're going to say pricing equals get pricing. Red flags, bells should go off. You never imported get pricing. Well, guess what? It's there. Just some more Quantopian magic for you. Assets, basically what prices on what are we interested in? We're interested in prices for all of the assets. And then we've got start date and end date. So let's just take this, copy, paste, and then I'm going to say fields equals open price. All right. So here what we have is basically the exact same dates, but I'm actually going to knock this down a month. And I'm going to knock this one up a month. And the reason we're doing that is so we have a little bit of data prior to our signal and a little bit of data after, because Alphalens is going to look a little bit prior and a little bit after, like after to continue computing market returns, and a little bit prior because we can actually look at what was pricing doing before the quote unquote event of our signal. So we want a little bit of data on both sides there. All right. Let's run that. Should have been running that while I was talking. It can take a few seconds, but shouldn't be too bad. So just as a quick note, take note of how long it takes for this to run, because we're getting minute pricing data for all these companies. At least I think it's minute. Maybe it might be daily. I don't know. Anyway, it's a lot of pricing data, and it's going to happen very fast. So now I'm going to go ahead and import Alphalens. And then coming down, we're going to do alphalens.tears. Not that way, tears dot create factor tear sheet. Notice pricing already finished. Crazy. Okay, what is the factor that we want to look into that we're hoping is an alpha factor? Say factor equals result, and we just want the sentiment column of results, so we're going to say result sentiment. And then we're going to say, okay, what do we compare this to? So we're comparing it to prices, obviously, and prices will be pricing. Then we're going to say quantiles, and we're going to say quantiles is equal to 2. I'll explain quantiles here in a minute, because I'm going to go on a rampage here. Periods equals 1, 5, and 10. Okay, so periods is just, what periods do we want to kind of think about in our tear sheets? So this is 1 period forward, 5, and 10. So that's 1 day, 5 days, 10 days. So maybe this data is, I don't know. I'm trying to think. You could get probably index and grab the second 0th index to find out if this is daily or minute. Anyway, that's okay. I'm still on that. You guys have probably moved way off that by now. So anyway, but this is days. So at least I think. So cool. So coming here to quantiles. So what is quantiles? Basically what it's going to do is take our sentiment data and separate it into 2 groups. These groups before separation are meant to come from a signal that, or I guess a factor that is going to range from low to high. It must right now range from low to high. So if you have something such as price to book ratio, where that's not a factor that ranges from low to high. Too low of a price to book, we start to wonder what is so wrong with this company that it's worth less than its tangible assets. And a really high price to book ratio is also not good, unless you're a technology company or something like that. Then you can start to justify higher. But anyway, the higher it gets, the worse it is. But also the lower it gets, the worse it is. So if that's yours, it doesn't mean you can't use it. What you probably need to do is do some sort of calculation of the deviation and have it ordered that way. Also, with quantiles, one of the major problems with, like, for example, sentiment, in theory, wouldn't it be nice, because the signal is -3 to +6, in theory there's 10 buckets, because you could have a 0 as well. Wouldn't it be nice if we could say we want 10 quantiles, and quantile, 1 would be the -3, and then quantile 10 would be a +6? That would be nice. But what happens? Let's run it. Did I do it right? Yeah, okay, it's processing. Well, hopefully we're going to get an error here. I don't want to eat my, yeah. So we get this huge error, but basically it boils down to, down here, bin edges must be unique. So we can see as it tried to evenly distribute by sample number into these bins, it failed because we had too many -3s, way too many -1s, too many 1s, just the right number of 2s though, the right number of 4s, and too many 6s. Okay, so it wants to evenly distribute into these bins or quantiles, when really it would be nice to be able to just say, just evenly distribute by the scale that we have or something. That would be nice. Now, in the documentation, the reason I was here is I was looking, and like you can see quantiles equals 5 here. That's probably really small. That's huge. Okay, good. So quantiles equals 5, but we can come down here to get this beautiful doc string, by the way. I love it. Quantiles, it can be int, or it could be a sequence of floats, e.g. here. That's live on the GitHub, but on actual Quantopian, they're using an older version. It just hasn't been updated yet. Update it. Okay, so it's just not that important compared to probably other things. Anyways, so we're gonna go with 2 because 2 works. And that's okay, because again, as long as you can do 2, which you should always be able to do 2, on a range, the lowers should be bad, the uppers should be good. So we're going to go with 2. But just know, like if you're watching this like a month from now, from the release date of this video or more or whatever, just know that you can probably get away with defining your buckets now, right? You could define as however you like. But right now, you can't. So if you're watching this right when I release it, tough luck. Okay, running. Hopefully no errors. Usually it spits out the first table pretty quick. There it is. Okay, so it's not everything. It's going to generate just a ton of graphs for us, but we'll start anyway. So I'm just going to run over the main things that I think you want to pay attention to. I'm going to skip over a lot of this. You can either learn more here. Let me see if they have. I'm not sure they've defined much on Alpha. Yeah, that's loud. Okay, man. All right. But you can learn more about Alphalens both in the GitHub, and then over here you can kind of learn a little bit more if you'd like. But I'll do my best to explain what we're looking at. So anyways, this is your annual alpha. Not the greatest. The beta, though, is fantastic. It's almost neutral. Again, you want it to be anywhere between -0.3, +0.3. We're very close to 0. Awesome. Down here, the information coefficient, basically what you're hoping for here is to have a value that is, 0.1 is fantastic, 0.01 is pretty good, anything less than that, the further you deviate from there, the worse it gets. But basically what it's asking is what's the rank correlation between your factor values and the returns. But just look for 0.01 or 0.1, ideally. Then obviously you've got the standard deviation, which, compared to our actual values here, that's, pretty significant. Anyway, coming down here, we've got turnover, which is important, but I think there's other graphs that are more valuable than the table. So this is the main, the first, after you look at your alpha, your beta, I would come down here. This is really useful because what you can see here is this is, the mean return by factor quantile over time. So periods, so after 1 day, 5 days, 10 days, 1 day, 5 day, 10 days. So this is quantile 1, quantile 2. So quantile 1, sure enough, after we get the signal, 1 day later, the mean drop. 5 days later, mean drop. 10 days later, even further. So, okay, and quantile 2, same thing, only vice versa. So that's good. We're very happy there. Scrolling on down, we're not we're kind of like our parade has been rained on, because this is a nice violin chart that's kind of showing us that, yeah, the mean is what we wanted, but the the deviation from that mean, the volatility that we have here in the spread is huge. That's going to be the main problem with this factor. So, and as we can see, the positive is much more valuable to us than the shorts are, because we're making a lot of mistakes here. Okay, now the next kind of, I think, 6 charts are just like this. You've got the long short and then the comparison by quantile. So here, it's factor-weighted long-short portfolio cumulative return over time. So this is just assuming basically if you shorted your quantile 1, longed quantile 2. So all the companies that go in there. And remember, this is all relative. So like during this time we did very badly, but it's totally possible that most companies during this time actually had positive sentiment. So yeah, it's falling because we're investing into we're shorting companies that actually have positive sentiment, but they just so happen to be the worst positive sentiment. So again, that's probably why you'd want to be able to hard code your bin edges in quantiles. Back to our graphs here. Let's get back to where we were. Okay, long, short, over one period, and then this one just splits them up, so you can kind of see. And in this case, it's just the inverse, and that's mostly probably happening because we literally have two groups, so that kind of makes sense that they would be relatively flipped. Coming on down here, same graphs, just over 5 periods, same graphs over 10 periods. So yeah, cool. Coming down here, top minus bottom, mean return. This just shows us, holy moly, all the noise that we have. The mean is good. And what that kind of signals to me, at least, is like right here, like these charts are like you literally are longing and shorting. And as we get to the bottom too, with the whole turnover, we have very low turnover. So it's totally possible that we're holding these companies that have, like, let's say negative sentiment that we're trying to short. We're shorting that company until the sentiment changes. We have no stop loss, right? Stop loss probably help us out here. So anyway, yeah, more turnover. Basically, you just have a ton of noise, or not turnover, rather, the mean return, but all this noise. Okay, then here you've got average cumulative returns by quantile, and take note, the order has been swapped on you. So up to this point, quantile 1 has been green, quantile 2 is red, but they flipped them on us. So now quantile 2 is red. So this line here is like where the signal happened. So what happened after the signal happened for quantile 2, the good quantile? Well, it went up. Great. On quantile 1, the bad quantile, what happened after the signal? It went down. But we can also see leading up to that signal what happened. Basically the same thing we just watched. So basically, what we know to be the case at this point is that, in general, sentiment seems to be trailing what otherwise is returns. We still had alpha, it's still good and predictive, but it's trailing. So that's something you want to just think about. Now, coming on down here, kind of the same chart as above, you got the nice event horizon here, but you've got the spread. So the mean is down, but you also can see the spread of, basically how wrong are you. And it's important to notice too, like here, yeah, the mean, it spreads all the way up, past 80 basically. And this one only goes down to about, minus 40. Coming over here, you've got this spread basically all the way down to about minus 40 and up here up to about 20. You've got just a massive spread. You're more likely to be wrong when you're wrong on the shorts, it looks like. And also you can just tell by the mean line itself, it's just not as negative as the positive is positive. So it could also just be the case that, with the sentiment signal, only buy into positive sentiment. Don't let negative sentiment dictate a buy or sell. Coming on down here, this is just information coefficient over time. Nothing really too much to see there. And then also you can see, basically over the years, your monthly 5-period IC. So just very specifically, these are your months, these are your years. Quantile turnover, rank autocorrelation, and we are done. Okay, so I just quickly ran through the charts. Basically, I think you can get pretty much the main bulk of information you need from, alpha, beta, come down, cool, come down here. And these are like the first charts you should look at. And immediately when we see this huge spread, we already kind of know the rest of what we're about to see in the rest of this, at least for this signal. But these are still pretty useful to see like what's happening over time for this signal. Okay, so at this point, given the workflow that we've talked about, you would almost certainly go back and sentiment is okay alpha factor, but and in a strategy we'd probably want a stop loss, but we're going to need some more alpha factors. We want to combine alpha factors. So we would, we've got sentiment, cool, write that down. Let's find another alpha factor and find a few alpha factors, and then you combine those alpha factors before you would do a back test, most likely. Now, what I'm going to do now, though, is, basically the research of alpha factors and combining those, that's like the challenge of Quantopian and making a good strategy. I'm going to leave that challenge to you. Now, since we have some alpha here, let's take it to an actual back test. So we're going to back test in the next tutorial. And basically that back test is, pretty much this pipeline right here. And then we'll back test it, and then we'll come back here and feed the back test through PyFolio and see what more we can learn. So anyways, that's it for this and the kind of intro to Alphalens. If you have any questions, comments, concerns, whatever, feel free to leave them below. Otherwise, I'll see you in the next tutorial, and we'll back test this bad boy.